Welcome to Market Call. Thanks for joining us. I'm Morella Fernandez. David Burrows with us on the show today. He's Chairman and Chief Investment Officer, Barometer Capital Management. He'll take your questions on North American large caps and ETFs. Here's how to reach us. 1-855-326-6266. If you want to call in, you can also email questions. Market Call at bnnbloomberg.ca. David, thanks for coming in today.
Great to be here.
Let's talk first about American inflation numbers coming in a little bit under what was expected. Why do you think we haven't seen a big uptick in prices in the U.S. as a result of tariffs since Liberation Day was in April?
Right. I think the reality is that companies are off the bat trying to eat some of these tariffs costs. And the question is, how long and how high will they be? And ultimately, companies will start making their decisions. But off the bat, I think that they've worked hard at keeping their prices sort of in check. Housing inflation is still pretty sticky, and that's something that could moderate. But on the other side, over the last few months, we've seen an uptick in commodity prices, and that's going to start feeding through, I think, into the inflation data. So that's going to be a little bit tricky. For those that want rate cuts, the moderation in inflation data near term is positive, but I think that's going to be tricky. And one of the things that's starting to pick up is energy prices again, and that'll feed through the system. I
thought for sure clothing prices would be on the rise, but in fact they have declined, especially with the markup on China and some of the other Asian nations, which send a lot of that this way. But that hasn't come through. Do you think that's the same reasoning there?
Well, I think it's going to take some time for that to feed into the data, and so I mean it's great. The market signaling is still that inflation is a concern because inflation-oriented assets are outperforming, and I don't see any change in that.
We're still sort of mixed results, but mostly in the green. So where's the momentum coming from these days?
Yeah, it's interesting. For all of the people that are concerned that tariffs are going to slow things down, the signaling from the market has been quite different. When you think about where leadership is, financials continue to lead, especially the capital markets banks and investment banks have been performing well, very market sensitive. We're also seeing strength in industrials in general, which sort of belies, concerns about the economy. And then when you look at defensive sectors, consumer staples, REITs, things that are sort of bond proxies, there's no sign of any strength there, no relative performance. So if you thought things were slowing down, you would expect them to pick up. And, I know we're in the middle of bond auctions, 10-year today, 30-year tomorrow, but, longer-term yields have been building in a bigger and bigger premium for the term, the time you're locking the money up. Again, that sort of talks to the risk that, governments continue to spend, they continue to rack up more debt, and so more inflation-oriented assets are performing well. Basic materials, gold in particular. Uranium performing really well at fertilizer stocks. So those don't point to a deterioration in the economy.
Got it. All right, we're going to take a quick break, line up some phone calls for David Burrows of Barometer Capital Management. He's taking your questions on North American large caps and ETFs. Here's how to reach us. Back in a moment. Welcome back. Thanks for joining us here on Market Call. We're going right to an email from Dennis. He says, I've held Intuitive Surgical Systems, ISRG, for a while. What are your thoughts on the company? David, we'll turn that over to you.
Yeah, so when we look at companies, the first thing we look at is the group that they're in. And you can have a great company in a group that's out of favor and have a difficult time. Arguably, Intuitive Surgical as a company is going to be a big beneficiary of this move in AI, and obviously, robotics and healthcare are very, very helpful. The problem is that the healthcare device companies in general are under some pressure, and healthcare is under some pressure. So, nice house in a tough neighborhood.
Yeah, there's no real reason that healthcare stocks have fallen out of favor, is there?
I think that if you look across the different groups like the healthcare providers and the pharma stocks and so on, there is political pressure on the group. It's the biggest industry in the U.S. and it's a place that they're working at trying to hold cost inflation down. But it's not economically sensitive. And the more economically sensitive sectors are gathering steam. They don't have a lot of pricing power right now. In general, we're trying to focus on companies that are generating tons of cash, and it's a growing cash flow and a nice growing dividend stream. And these companies have a harder time in general, healthcare, in passing costs through right now.
Got it. Okay. Dennis, I hope that helps you out as we move to the phone line. Sal on the line from Toronto. Hi, Sal. Sal, are you there?
Hello.
Hi, Sal.
Oh, well, thank you very much. Please, EQB seems to be drifting down, not getting traction. Your thoughts on Equitable Bank? Thank you.
Okay, thank you for the question, David. Let's pull up the chart for EQB and talk about that. Digital sort of financial companies, digital banks, generally speaking, how are they doing, in EQB in particular?
Look, financials are the strongest group globally, period. And different groups within financials have different fortunes right now. The regional banks are having a harder time in the U.S., and some of the smaller, more mortgage-oriented banks are having a harder time as well. The way I would look at this is a company that has weakening relative strength versus the market and weakening relative strength against the group at a time when the group has been performing well. You've got a pretty big tailwind. I'd be more cautious. I think the concern is the housing market in Canada continues to weaken. And I just think probably there are better places to go. We're going to talk about a global bank today. We think they have some tailwinds. And some of the largest banks are winning on technology, and infrastructure. So I'd be a little more careful here.
If you already hold it, would you continue to hold it?
I would move on.
You would move on. Got it. Okay, let's go back to the phone lines. Monica's on the line from Burnaby, BC, with a question. Hi, Monica.
Hi, thank you for taking my call. This is in regards to AI. I'm just wondering what you think of the industry in general and what the future would be. And also, if you have two companies that you can suggest would be good to buy, that would be great. Thank you so much.
Okay,
Sure.
Thanks, Monica. So a wider question, because there's obviously the very technical plays in AI, then there are the offshoots, the companies that will benefit from it. Where do you land with AI? What are you guys looking at?
Look, we've been seeing a massive build out in the infrastructure, and we are seeing a massive pickup in adoption. I was looking at some data today. Like every major technology that comes along, the newest one gets adopted faster than the last one. So adoption is very, very high across companies, and I think we're still learning where it's going to be most useful. We're seeing a big pickup in inference demand. So what are we going to use that infrastructure for to generate revenues? And so some of the very largest of large caps companies are the biggest beneficiaries, companies like a Meta, or even a Netflix is a beneficiary. I think that one of the things that we're looking at right now is it looks as though some of the regulation around the semiconductor industry is going to be reduced.
Specifically China?
Specifically China, but some other countries as well. And that could mean that there could be an expanded market for the semiconductor manufacturing equipment companies, like KLA-Tencor, for instance. That would be something I would be taking a look at. And Broadcom has been a very, very strong performer. We own some NVIDIA. We came out of it last year. The semis went through a full year of correction all the way down to the 200-week moving average. But relative price performance is strong, and Broadcom and NVIDIA, I think, continue to be the two biggest winners on the semi side. And again, that's more economically sensitive, more cyclical. They have pricing power.
Yeah, they do. You have to stomach a little bit with Donald Trump's on and off
100%
decision on where those semiconductors can go. Okay, we hope that helps you out, Monica. Let's move on to Nicole, who's calling from Montreal today. Hi, Nicole.
Hi, guys. David, one of my favorite guests on the show. Just wondering your thoughts on BWXT, a former topic of yours.
Yeah.
Have a great day. Thanks.
Look, the whole nuclear energy theme has really jumped back into the square. We know, no matter what happens with tariffs and other things, that there's going to be expanded demand and almost exponential demand for energy. Mm-hmm. And we think some of that's going to come from natural gas powered turbines, and some of it's going to come from nuclear. We've seen a lot of announcements over the last while about further adoption of nuclear reactors. BWX Technologies really began the pioneering work in small modular reactors in the late 1950s. They provide all the nuclear reactors in the U.S. Navy, aircraft carriers and so on. They're a big partner of Ontario Power in some of the work that's being done here. So I think that this is a beneficiary. The stocks had a great run back. If you look at the URA ETF or the NLR ETF, which is a nuclear ETF, they're making new highs. And the key stocks are as well. Cameco is a recent add for us. And I think that this is a pretty clear leadership theme. And there's big bases, big technical price bases that could support higher prices.
I was going to ask you because BWXT is at 134, I think, today. Would you buy in at this point? Of course,
Yes.
It dropped in April like everything else, but it was down to like 89.
Yeah, it's amazing how many big, solid, technical price charts, had false breakdowns in April and shook a lot of people out, including us in a bunch of positions, But they very quickly have reestablished. And so that's a sign of strength. And I think you can't ignore, companies like Cameco that have giant multi-year bases that are breaking out. And BWX fits in that theme.
Got it. Okay, we're going to take a quick break. We're going to be back with David Burrows of Barometer Capital Management, taking your questions today on North American large caps and ETFs. Back in a moment. Welcome back. Let's go to an email from Ryan. He says, can I please get David's thoughts on Palo Alto Networks? Is cybersecurity a sector you would just recommend owning the winner or diversity? Good question. CrowdStrike, of course, came in and its stock went down on its most recent reporting. So generally speaking, cybersecurity, where do you land?
Yeah, so look, cybersecurity is the utility of technology. It's something that is a necessity. It's not economically sensitive, so it's not going to get a big boost, in a strong economy, but it's very, very consistent. We own CrowdStrike, and actually CrowdStrike came charging right back. So the expectations in the group are high, and the multiples aren't cheap, but we have some exposure. To be clear, we actually don't have a ton of tech exposure. We've moved more to a little bit more economically sensitive names. But we own CrowdStrike, we own Microsoft, we own NVIDIA, and we could own Palo Alto. We just own CrowdStrike.
Got it.
And we also own the cyber ETF.
Okay. All right, let's go back to the phone lines. Jim's on the line from Elliott Lake, Ontario today. Hi, Jim.
Good afternoon. David, I'd like your thoughts on Abbott Labs. When you look at its performance long-term, short-term, it's nothing but green and positive. Where do you think it stands amongst its peers, and would you think that this is a good entry point?
Right. So, in general, we have almost no healthcare exposure.
And is that because you got out of it, or generally you have not
We
put
haven't
money
been
into
in
healthcare?
it. We haven't been in it for a year. Relative price performance for the group has been weak. That being said, we're seeing some improvement around the edges, and it's our strategy always to look for what is it that's held up better than the rest, what has been a strong performer while the group has been weak, and Abbott would fit that tab. So it's performed better than 78% of stocks in the S&P over the last 52 weeks. Technically, it's made a series of higher lows. Earnings estimates for this year have moved higher than lower. So earnings momentum, revision momentum is decent. It's not technically broken out for us, so we're not there. But it's one that we would be watching.
Okay, you've got it on the sidelines.
Yeah,
All right.
so if I owned it, I would hold it.
Okay. Let's go back to the phone line. Amy is on the line from Toronto today. Hi, Amy. Amy, are you there? Okay, it looks like we've lost her, so I'm going to move on to Joe calling from Orangeville today. Hi, Joe.
Hello.
Hi, what's your question?
Yeah, Next Gen Energy. At what point is it? Are they with the application with the government? And given the point that where is it at the moment? If he has an if I knows where he put it at the one of the bank will put it at 1450. What does he think about that?
Okay, thank you for the question. So Next Gen Energy will pull up that line chart right now and see where it is.
So Next Gen is a stock we've owned in the past. We don't own it. We were disappointed with some of the governance decisions that were made at Next Gen.
Okay.
Taking money they raised to go buy uranium. Some question around that. It has not been a leading performer in the group. It's just a little more speculative. So if I had to pick a name, I'd pick a Cameco. Or you could own the URA ETF. This is a very volatile group. And so you have to size your position properly, right? The outlook is very, very good, but there have been a lot of disappointments along the way. So you have to pick your spots, and I would just stick with quality. And in the case of Cameco, the Westinghouse business is getting better. The uranium business is getting better. So we like to buy strong, or what I would call good getting better.
Is the ETF a better recommendation in that space, do you think, for people?
Well, I mean, we're comfortable owning Cameco, but the ETF is a great way to do it. You're not taking on too much business risk.
Got it. So if you are a little less, or if you are risk averse, go ETF, I guess. If you want to take a bit more of a risk, go straight into Cameco or something like that. All right, let's go to Colin from Sarnia. He has a question today. Hi, Colin.
Yeah, how you doing, Morella? And good afternoon, Dave. My question is about short the S&P, not leveraged. Symbol SH. I've got a bid in for it, a little below what the market is. And I'm wondering if you see anything in the point and figure on the S&P 500 brewing. And just a quick note, thank you for mentioning Tesla. When you were on in the last part of the year, I put up my sell price much higher, and that was very helpful.
That's great.
Thanks for the question, Colin.
So, Colin, I'll just come at it from the way we look at things. Everyone looks at things differently. What I care about when we're looking at a universe of stocks, in this case the S&P 500, is has breadth been improving or deteriorating? So if you take 500 companies and ran a point and figure chart on every one of them, is the percentage of stocks in uptrends expanding? There's no bear market ever happened while breadth was expanding. We take the same approach and track the percent of stocks trading above their 50-day moving average. We do the same thing, percent of stocks trading above 150-day moving average. And all of those things are expanding. So forget about what we think about seasonality. Second 2 weeks of June tends to be a week to 2 weeks. Market's been pretty good since April. There's still news risk out there. The S&P hasn't been able to make a new high yet, but breadth is improving. So unless that started to deteriorate, picking a price and hoping you're picking the top, I think, is a risky business. Now, you may be deciding to hedge your portfolio with that security. I just can't point to something at this point that tells me that's the right thing to do, especially because stocks are outperforming bonds pretty steadily. And around the world, more and more markets are performing well. So that speaks to flows into equities as a whole, not just the US, which was the only leader for 10 years.
Yeah.
Now the global market is doing very well too. So I would take your time and wait to see some technical indication that we're going through a top before you do that.
Got it. Okay, we are going to take a quick break, line up some more phone calls and some emails. We're back in a moment. Welcome back to Market Call. Let's go through past picks for David from April 3rd of 2024, so over a year ago. At the time, you recommended JP Morgan, New York Stock Exchange, 198.30 American, now up to 269.16, 36% upside return, 39% upside return. JP Morgan, sort of a solid trace along the lines of Royal Bank in Canada. Do you still like it moving forward?
Yeah, look, buy the leader. You know, it's the best bank in the world. They've proven it over and over again. They've got the most solid balance sheet. They've got the best technology platform. Of course, they've got great management. And they continue to get dominant market share. Anytime there's a wobble, they get an opportunity to buy cheap assets. I think, as I said earlier, the most clearly defined leadership theme in the market is financials globally. So why wouldn't you want to buy the one that continues to win? Keep in mind that when U.S. banks rolled over in 2008-9, the bank ETF didn't make a new high till 2021. JP Morgan made a new high in 2013, right? Buy the one that's most resilient on the way down, buy the one that's strongest on the way up. They tend to be the same thing. So,
just out of curiosity, if there's a downturn, which seems sort of less likely or not as hard of a downturn, does that bother you for financials?
No, I mean, look, we're in a world where long-term yields continue to steepen against lower short-term yields. So they've got powers in the hands of the lender. They have an opportunity to get paid. Capital markets are strong. There's likely to be lots of monetization. A lot of private equity would love to get some monetizations done. JP Morgan would be in line for that. Their wealth management business is very, very strong, and their global business is strong. So it's a great way to participate in strong financial markets is through a strong bank that's in all those areas. Okay,
let's get to your next past pick, which was Alamos Gold. On the TSX at the time was 2010, a year ago in April. Now it's 37.16, so 85% upside return, 86% upside return. Gold off its highs, and with equities coming back, it could, sort of get tempered a little bit more. Any concerns for Alamos Gold, or do you continue to hold?
No, gold bull markets go on for a long time. And this one hasn't been driven by private investors, it's been driven by central banks. And the cash flow that's being generated by these gold companies is going to continue to rise, and they are inexpensive. So they can consolidate, and they are. 7-8 weeks ago, we started a consolidation, which we're probably still in. However, the smaller producers have started to join the rally, which is what tends to happen in the second leg of a bull market, and the silver stocks have started to perform well. Nobody owns these things. Like, if you looked at the average family office, they're probably 1%. And so I think we're very early days. Private investors have not been buyers. The number of units of the GDX ETF really have only just started to grow, meaning money started to move into the group. So they can consolidate a bit here. I don't think there's a ton of risk, and I think that you want to buy geographically favorable, like in good jurisdictions, companies, and Alamos is one of those.
Where do they operate?
It's primarily in Canada.
Got it. Okay. Let's go to your third pick from last year. Imperial Oil on the TSX at the time was 97.84 up to 104.17. A 6% upside return, total return of 10%. What's your forward look on oil? Prices have been depressed and fluctuating. We are seeing emergence of other energy markets now, as you mentioned. What do you think about oil moving forward? I know Imperial is expanding, but still.
So our basic premise is that the Canadian oil sands companies have unbelievable assets. And anytime you can buy a company that's cash flowing what Imperial or CNQ is cash flowing and generating the kind of shareholder returns, dividend growth, and share buybacks, my premise on Imperial Oil was, look, you can buy it and get paid a great yield, same on CNQ, and they're well north of 20% dividend growth. And yes, in April, all of the commodities took a shot on the tariff news, but to me, that's looking like it was a false breakdown. Oil's just broken a triple top on a point and figure chart at 65. And these companies look like they're about to reaccelerate. So I would be a buyer of Imperial. I'd be a buyer of CNQ.
Got it. Okay, we are going to take another break. We'll be back with your phone calls and your emails for David Burrows of Barometer Capital Management. Back in a moment. Welcome back. Thanks for joining us on Market Call. Let's go to Henry on the line from Vaughan, Ontario, with a question. Hi, Henry.
Hi there. I'd like to know about Freehold Royalties. It seems to be undervalued and pays a solid dividend. You think that the price of oil is slowly rising. So to me, Freehold Royalties is way undervalued. What's your opinion, please? Thank you.
Thank you. We'll have a look at Freehold Royalties.
So Henry, again, we all looked at things through our own eyes, and in our process, I tend to focus on the sort of the top third of relative price performers in a group. We tend to believe that, the best companies tend to keep getting better. And, for Freehold, they got decent assets, but relative price performance versus the market has been weakening since 2022, so 3 years. And at the same time, companies like Tourmaline or companies like Paramount, technically better set up. There's a lot of opportunity for yield in the energy space and dividend growth. And so we just felt that we would prefer to have the price behavior support our view. Because if it's not, it may be that you're missing something. I'm not saying it's not a great company, but if I were looking at choices, we would prefer to be focused in an ARC or a Tourmaline.
Got it. Okay. Henry, I hope that helps you out. We're going to move on to Chris calling from Hamilton, Ontario. Hi, Chris.
Hi. Good. Thank you for taking my call. I'd like David's view on Whitecap. It seems to not really be doing a great deal. And I just wondered, because it's sort of a mid-oil company, whether the prospects are that good for it. Thanks very much.
Okay, thanks for the question. So Whitecap and Varen, were you positive on that deal?
So this is the same story as Freehold. There's a lot of choices, and we're not the sharpest tools in the shed. We aren't focused on the one PE versus the other because one has better growth. Could be that it's worth a higher PE. But as I said earlier, we want the technical picture to be as supportive as the fundamental picture. And given a choice, I'm going to buy the one with the strong fundamental picture and a strong technical picture together. And so I think it's possible that this theme is going to pick up steam. Obviously, we own ARC because, liquefied natural gas is going to come on and pricing is going to get better, and they're really the leader in the Montney. So we're not value investors. We don't buy things that are cheap, hoping that they're going to get less cheap. We prefer to buy the companies that people are recognizing that they're a leader in their group and they can be revalued and get multiple expansion.
Yeah, a lot of the times all the fundamentals are there, but no one's looking at it. Right. Got it. Okay. Let's go to Sam from Toronto with a question. Hi, Sam. Sam, are you there? Okay.
Hi there. Yeah.
Hi. What's your question?
Yeah, my question's on TC Energy. I was wondering if now would be a good time to enter into a position in TC Energy, given that the LNG gas project should be coming online soon. And what are your thoughts on this company versus some of the other peers in this space? Thanks so much.
Yeah.
You just mentioned ARC, but do you like TC Energy?
Yeah, so we have owned TC, and one of the things I'll note sort of from the macro top down is that, defensive assets are garnering less and less a bid as people are getting more comfortable with economic risk. And so we have recently used TC as a source of cash to add a little bit more beta in our portfolios. And so I think it's a great company, but I watch relative price performance, and relative price performance for the pipes has started to back off as it has for utilities. Mm-hmm. And it's not that they aren't good companies. They're great companies. It just may be like we have to choose 30 companies for a portfolio. 3 or 4 give us way more return than we expected. 7 or 8, a whole bunch are really good, and some are okay, and some don't work. So we've decided to move on, not because we don't think it's a good company, but we just think that the group could see some distribution, especially if long-term yields stay high. The pipelines carry a lot of debt, and financing costs could get more expensive.
Okay, so TC Energy isn't one that you're necessarily looking at.
We're not looking at adding. We've actually just recently sold it. And again, not because we think there's something broken there, just we think that there's alternatives that are better.
Got it. Okay, let's go to Amy from Toronto with a question. Hi, Amy.
Oh, hi, Dave. My question is all related to that some stock has been banked due to the tariffs, and they're probably good companies. So my question is on DuPont. If we don't take that one, another one is also beaten down. It's a Constellation brand, the one that sell alcohol or something. Okay, I'll hang up and listen to your advice.
So I didn't clearly get the question. I know it was about DuPont.
I got a question about, I think, the companies that have been hurt by tariffs.
The tariffs, okay.
Yeah. So the chemical stocks in general really, have been weak over the last, forget like April, like the last 2 years.
Okay.
So you can't really pin this on tariffs. Within the chemicals group, again, I talked about trying to find things that have started to behave better. And within the chemicals, I think that the fertilizer stocks are much more interesting and have a better technical setup. So like a Nutrien, for instance.
I was going to say Nutrien's coming back, yes.
Yeah, and others in the peer group. So those two things make that interesting to us. We recently bought Nutrien. And again, because the commodity-oriented space is continuing to firm up. And there's a very long-term base, really goes back to 2016 in Nutrien and has been tested. We've made higher lows. So I would be more inclined to look at that.
Got it. Okay, let's get to one last caller of this block, Paul from Brampton, Ontario, with a question. Hi, Paul.
Hello. I'm looking at the Vermilion Energy. It's going back up at the moment. There's been, one of the banks has been put as a buy again. From the $30 they used to be, and I have some that I bought a lot higher than what's in now. What does he think that it's happening at the moment? And is there any restructuring going within the company? I know they sold us a couple places recently.
Yeah.
Okay, thanks for the questions.
Sorry, I'll be pretty quick on this one. My answer is going to be the same as on Freehold. Poorly performing stocks within a group are not our target. And there's other people who are really good at picking low-priced out of favor companies. It's not us, so I wouldn't be a buyer of Vermilion here.
Okay, quick and easy. We are going to take a quick break. We're back with David Burrows in just a moment. Stay tuned. Welcome back. Thanks for joining us. Let's go back to the phone lines. Moez is on the line. He's calling from Vancouver today. Hi, Moez.
Hi, thank you for taking my call. David, you are one of my favorite guests on the show. Great show. Thank you. My question is on Eaton, ETN. What is your opinion of this company? Thank you.
Okay, thank you for the question.
Yeah, so we quite like industrials as a whole, especially global industrials. Eaton, of course, sells a lot of their gear into power generation and power control, which we think is going to be a really important place to be. We don't own the stock currently. It came down during the correction and sort of tested the long-term moving average, which was around $220.
Okay.
And is back above all the key moving averages here. So from an earnings perspective, earnings revisions, last three revisions have all been higher. 2 out of the 3 revisions for next year are higher. So you've got solid backing from the group. You've got nice rising moving averages. So technically it's set up well. It hasn't made a new high yet, which is the only fly in the ointment. We own GEV, GE Vernova, sort of focus on the power gen space. But, Eaton, I think, is probably a decent holding.
Got it. Okay, let's go to Ted from Newcastle, Ontario. Hi, Ted.
Hi. Can I get your view on Hydro One? Thank you.
Okay, so a lot of energy questions today. So Hydro One.
Yeah, I made a note. Like so many of the questions over the last couple of blocks have been defensive stocks. And I think people in general are feeling that way, because there's a lot of uncertainty and they're looking for dividends. The one thing I would say is I would prefer to buy dividend growth right now as opposed to high dividend, low growth.
Why?
Well, because high dividend, low growth doesn't tend to be economically sensitive. It's very defensive. If things slow down, it'll act a lot like bonds. But the bond market's not behaving very well. And I'm not getting any relative strength in general out of the defensive stocks. And so I know it's counterintuitive because we're all a little nervous about what's going on. But what is clearly doing better are things that have pricing power where they get dividend growth. So we have scaled our way out of Hydro One, which is a holding for a long time. But just some of the moves we've made over the last few weeks are to reduce the defensive positioning and recognize that the market is showing us that there is more economic strength out there maybe than people think.
Let me take that to the other level. Do you think people have realized what's going on with Donald Trump in Washington and said, okay, we get the game now? We feel a bit more secure?
Yeah, I think that's part of it. And the big deal is that the big themes that led into the tariffs were all economically sensitive. So it's rare that one piece of news, even a big piece of news, completely changes the picture. I think the biggest structural change we've seen in years is the generational low in interest rates in 2020, which is now 5 years ago. But if that's the case, like it was in the late 1940s, we'll get 20 years of rising long-term interest rates. And so defensive stocks have a hard time and bonds have a hard time in that environment. And what's working are things that benefit from inflation. Even though the near-term data is sort of a little weaker, the stocks that benefit from that are leading. And so we're leaning towards those things that give us an inflation hedge.
Got it. Okay. We hope that helps you out. We're going to move on to Carlos in an email. He says, I am wondering if Fortis is a sell right now. Let's pull up Fortis and have a look at the chart. What are your thoughts on Fortis?
It's the same picture. It's a great company. They've been able to raise their dividend forever, but the dividend growth is slow. It's like 3-4% a year. And, for the dividend, it's fine. But for the dividend that had more growth, I would be leaning more toward a large cap resource producer that's generating tons of cash. I think there'll be much better inflation protection there or in the banks. JP Morgan grows their dividend more than 20% every year. The Canadian banks, same thing. So I would lean more in that direction.
Got it. Okay, let's go to Dan. This is another email. Should I sell JNJ? Held for a long time, but flat for a while. I'd hoped for court settlement. Your opinion. Tell me about JNJ.
Well, so J&J, put in a high in 2022, March of 22, and it's been a series of lower lows and lower highs since then. The only positive that I can point to is the most recent pulled back to a higher low. And you can see on that chart, there's some improvement there. And as I mentioned, healthcare has been really out of favor. We're seeing some improvement around the margins. So if you own this one and it's one position in a bunch of positions, you're probably not going to lose a bunch of money here. But I don't see it being a leading stock in the near term. Again, lean more economically sensitive, lean more inflation oriented. Companies where if their costs go up tomorrow, their price can go up the next day.
All right, we are out of time for phone calls and emails today, but don't go away. David's going to stick around and share new top picks after the break. Welcome back to Market Call. Thanks for joining us. Let's go to new top picks from David. His first on the list is ARC Resources on the TSX. Out of these companies, natural gas companies, oil companies, why ARC?
Right. So I'm going to speak through my lens. In our world, we own 20 to 30 companies in a portfolio. Our job is to be an inventory manager. Mm-hmm. And if you run a retail store, your job is to have inventory on the shelf that people care about today. So we only focus on themes that we think are in process of being revalued favorably. Tends to be that they are in sectors that maybe are less owned, but are showing something changing for the better. And in that world, we want to own the best company we can find, that we don't have any major fundamental risks if it doesn't happen immediately, but where multiples will expand if people start to look closer at this group. So ARC really is the leading Montney operator and low price producer for natural gas. They got a great balance sheet. We generally are not looking for companies with debt currently because we think financing costs are going to keep going up. They have great 3-year dividend growth of over 35%. And there's a catalyst, the opening up of the LNG markets globally is going to benefit ARC in particular with their relationship with Cheniere, who have infrastructure to ship natural gas overseas. And Attachie became operational at the end of 2024, their operation there, and it's going to ramp up over the next 4 years. So that's another positive change. We think that the demand for energy, power, electrical power, is going to fuel demand for natural gas as one of the sources. And so all of those things lead us to believe that not only could price go higher because natural gas prices can go higher, but the multiple investors pay could go up. And if you've got rising price and rising multiple, that can lead to a significant increase in share price.
And you see foreign markets as sort of the customers for it. I know China's been buying a lot more of Canada's energy, Europe as well.
Yeah, look, I mean, global prices for natural gas are obviously higher than they are in North America, which has an abundance. And the more that we can move it offshore, the better. And it's just so sad that it hasn't happened more quickly in Canada.
Yeah.
I mean, I think terrible decisions were made. But ARC is benefiting from what's happening in the U.S.
Got it. Okay, let's go to your next forward-looking pick, Agnico Eagle, which is on the TSX, of course, very well known. Why do you like it moving forward?
Well, we think that we're in the very early stages of a gold bull market. So again, like JP Morgan, buy the best operator. And Agnico has multiple properties, about 3.5 million ounces of production a year. They are growing across 5 of their major projects, have exploration growth opportunities. They've proven over and over again that they know how to operate, and not a lot of gold companies do. It's got great dividend growth. Their acquisition last year of O3 Mining added 1.3 million ounces. That's a positive. And again, we think the multiples will go up as people realize how much cash these companies are going to generate. If gold just stays at $3,400, these companies flow a ton of cash. My guess is gold price is going higher. And so again, this whole group can be revalued.
You said they know how to operate. What do you mean?
There are so many companies that may have a good asset, but have a hard time getting it out of the ground. The old line is that a gold mine is a hole in the ground with a liar standing on top. Agnico is the institutional favorite because they have delivered over and over and over again. And there's lots of risk in, being a miner. And so you want to know you've got somebody who really understands how to execute.
Got it. Okay, let's go to your next topic, Banco Santander, which is Europe, Latin America, and in the U.S. So it's banking, but why do you like them?
So this is a $124 billion company. They've just surpassed UBS in size. First of all, financial services only really got going in the U.S. 2-3 years ago, and there's probably a 10-year bull market in front of us. Global stocks underperformed for, depending on where you're looking, Japan 30 years, Europe since 2008. When a market goes through a sideways period for 10 or 15 years and eventually makes a new high, that's the beginning of a new long-term bull market, and virtually every major global market is doing that right now. So we want to buy the leading group in a market that can be revalued. Global stocks are much cheaper than U.S. stocks. And global investors are maximum long the U.S. market. Now, the U.S. dollar is falling against every major currency, and global markets are now outperforming U.S. markets, and I think that can go on. And, Santander's a great bank. It's in Latin America, it's in Europe, it's in the U.S. They've got a great digital banking platform. They're getting a great return on their tangible equity of between 13 and 15%. They've got a great balance sheet, but it trades at 9 times. JP Morgan's 15 times, Bank of America's 13 times, Royals at 14 times. So we're going to get a nice dividend that's growing nicely. They're buying back shares, and global banks can be revalued relative to the rest of the world. So again, if you like global markets, buy a global bank because they're exposed.
Are they originally from Latin America?
Yeah, so Spain originally, But, you know, they have a great investment banking business, and they're very good operators and very good allocators of capital. So when global stocks start to perform, and they haven't in years and years, very few people, North Americans, if you look at the average global fund, it's 70% U.S. stocks.
Yeah.
You know, we built a global fund 100% ex-North America, and those markets are all performing well.
Got it. All right, David, I have to leave it there. We're out of time, but thank you for your time. I appreciate you coming in.
Thanks for having me.
That does it for us on Market Call. Thanks very much for joining us. We'll see you again tomorrow. A look at the markets as we head to break.